gold suddenly is the flight to quality asset. People, I think Costco is selling gold retail and they can't keep it in stock. Well, it's certainly behaving differently than it was for the last 4 decades. I mean, what we've seen is in the last 15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up. This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently. Usually when the Fed starts cutting interest rates, rates across the yield curve go down. The 10-year Treasury almost always goes up immediately following the first Fed rate cut, and then it keeps rallying for a while. This time, the 10-year yield went up, and the yield curve is steepening. So I think what we have is a recognition that the interest expense for the United States is untenable if we continue running a $2.1 trillion budget deficit and we continue to have sticky interest rates. One thing that people fail to appreciate is how much the average Treasury payment has gone up. The average yield, the average coupon on Treasuries was below 2%. The entire Treasury market, all 30-odd billion of it, you average it all together. Some of them are old, they were issued with higher interest rates, but it was below 2%. Now it's pushing 4%. And as long as bonds are maturing, and there's trillions and trillions of dollars of them maturing, a lot of them were issued back in, 2009, 2008, these other time periods. Even if you just issued them in 2019, some of these are starting to come due. And they were issued with coupons of 0.25%. And now it's 4.25%. So it's 400 basis points higher. So this problem continues to build. And there's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%, probably going to go higher on the inflation rate because the ones that are rolling off from a year ago, I mean, the cumulative, I think, headline CPI that came out today, it was a 0.18. But the one that was rolling off, I think, was 0.1. And if you do the next 2 months, those 3 months together, that quarter, the cumulative rise from a year ago was 0.1. So we're likely seeing the low point in near-term inflation. So yeah, I think the reckoning is coming, is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that. So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005. And there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position. And the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out. And so this is a moment where finally you have the setup where non-U.S. investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working. And I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury rate will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing on buying long-term treasuries. And when they do, you have to very quickly, and hopefully you do it the day before they announce it. But we don't have access to the day before stuff. That's for the primary broker dealers. But you would need to buy long-term treasuries as much as you possibly could, because when that gets announced, it'll be just like when they announced buying corporate bonds in COVID, where all of a sudden the corporate bond market went from down 20 points to right back to where it started in just a matter of a few days. You could get a 20-point rally on the long bond if they announced that they're buying the long bond, because that would be a 100 basis point drop. I mean, it's a paradigm shift. We have a tremendous paradigm shift that's going on, where money is not coming into the United States, where the long bond is not a flight to quality asset. Gold suddenly is the flight to quality asset. People, I think Costco is selling gold retail and they can't keep it in stock, and gold has gone from, it was living at $1,800 an ounce not very long ago. And once it broke above 2,000, it was just straight up. And now it's basically a third of 10,000. 3,333 and 33 cents it was actually when I looked at it yesterday. So I think gold is a real asset class. It's no longer for lunatic survivalists and wild speculators. It's viewed as an asset class. And central banks have been accumulating gold. Gold was stuck in the mud because for a decade or more, central banks were selling it down. They've bought it all back.
So you buy gold?
I've owned gold since it was $300, and I also own some gold miners personally. But they bought it all back. It's amazing. They sold it at like $300, $400, and they're buying it back at $3,000. See, central banks are not very good long-term investors. We manage a lot of other people's money, and a lot of it is in the fixed income market. We're just protecting and waiting for much better opportunities. When I think about it, markets take the stairs up and the elevator down, which means they go up faster than they go down faster than they go up. And so when it really breaks, it's not down a couple of points. Even what we saw in April, that's not a real break of the credit market. A real break of the credit market is bonds drop 30 points. And everyone thinks they're cheap, but they have to sell. So you have an opportunity at some point to buy bonds down, I don't know, let's just say it's 25 points. High yield bonds yield about 2.5% more than Treasury bonds. So if it takes 10 years for that 25-point opportunity, you're going to break even. And it's not going to take 10 years. It's not going to take 5 years. I believe, but the panel before me said, I think is true. I think 27, 28 are likely to be a window of tremendous opportunity. Because I think by then, the Treasury problem will be even more in focus than it is today. And I think that it'll weigh upon market behavior. We need to restructure a lot of things in our system. We need to restructure institutions. We need to restructure political parties. We need to restructure our finances. All these things have been in place. It's the waves of history. Neil Howe calls it the fourth turning. He wrote a book called The Fourth Turning in the mid-'90s, predicting the credit crisis around 2006 using demography. Pretty good. And I know him pretty well, and we talk about it, and we have the same concepts, and that is that societies start with a pact. They have an economic system that produces things, and then they have, so that's the means of production, and then they have the property relations that split up the rewards. And when it starts out, and this would be, say, right after World War II or after the Civil War, it starts out that everybody kind of buys into how the system works. But there's a fundamental problem with this kind of duality of property relations and the means of production. Means of production change in revolutionary ways. Steam engine, radio, television, telephone, internet, AI. They're just explosions of innovation. But the property relations, they don't change very quickly. In fact, they're barely evolutionary in the way they change, because over time this becomes a wealth inequality, which of course we're in an extreme, where the people that benefit from the property relations, they don't want them to change because they're winning. So when you have tremendous concentration of wealth and power, the property relations become calcified. And meanwhile, the means of production are causing all kinds of disruption and intensifying the wealth inequality. And then suddenly the whole thing says, this doesn't work. We have to get the property relations to a right place where this isn't a feudal system, where there's the lords and the serfs. But that's what we have. And so we need to rejigger all of this stuff. So, and the Treasury debt problem, the interest expense unaffordability, is another offshoot of all this. It's all the same thing. It's that we need institutions that people believe in.